Practice questions 61 to 100. What does the term subrogation refer to in insurance? A. The process of reinsuring policies. B. The right of an insurer to recover costs from a third party responsible for a loss. C. The transfer of risk from an insurer to a policyholder. D. The payment of dividends to policyholders. Answer. B. The right of an insurer to recover costs from a third party responsible for a loss. Explanation. Subrogation allows insurers to seek reimbursement from a responsible third party after paying a claim. Which type of risk can be insured? A. Pure risk. B. Speculative risk. C. Gambling risk. D. Business investment risk. Answer. A. Pure risk. Explanation. Only pure risks, which involve the potential for loss but no gain, are insurable. Which of the following is an example of a moral hazard? A. Leaving a car unlocked because theft is covered by insurance. B. A hurricane damaging a property. C. A business experiencing losses due to an economic recession. D. A fire caused by faulty wiring. Answer. A. Leaving a car unlocked because theft is covered by insurance. Explanation. Moral hazard arises when people act recklessly because they have insurance coverage. What is a coverage limit in an insurance policy? A. The amount the insurer must pay annually. B. The total compensation an insurer will pay for a covered loss. C. The amount deducted from a claim before the insurer pays. D. The total number of policies an insurer can sell. Answer. B. The total compensation an insurer will pay for a covered loss. Explanation. Coverage limits specify the maximum amount an insurer will pay for a covered claim. Which of the following describes an insurable interest? A. The financial stake a policyholder has in the insured asset. B. The possibility of profiting from an insurance claim. C. The number of insurance policies owned. D. The level of risk an insurer is willing to accept. Answer. A. The financial stake a policyholder has in the insured asset. Explanation. Insurable interest ensures a policyholder would suffer financial loss if the insured item is damaged. What is an example of a speculative risk? A. A flood damaging a home. B. Investing in cryptocurrency. C. A car accident. D. A lightning strike damaging a tree. Answer. B. Investing in cryptocurrency. Explanation. Speculative risks involve both potential gain and loss and are not insurable. What is the function of an insurance adjuster? A. To underwrite new policies. B. To investigate claims and determine payouts. C. To sell policies to customers. D. To provide legal services to insurers. Answer. B. To investigate claims and determine payouts. Explanation. Insurance adjusters assess claims and determine how much the insurer should pay based on policy terms. What is an example of adverse selection in insurance? A. Only high-risk individuals seeking insurance coverage. B. Insurers offering policies at discounted rates. C. A person paying their premium on time. D. A business implementing strong safety measures. Answer. A. Only high-risk individuals seeking insurance coverage. Explanation. Adverse selection occurs when those at higher risk are more likely to purchase insurance, leading to increased claims for insurers. What is the purpose of a grace period in an insurance policy? A. It allows an insurer to deny claims without reason. B. It gives the policyholder extra time to pay premiums before policy cancellation. C. It increases the policyholder's coverage automatically. D. It provides a discount for timely premium. Payments. Answer: B. It gives the policyholder extra time to pay premiums before policy cancellation. Explanation. The grace period prevents immediate policy termination if a premium payment is slightly delayed. What is the function of a loss ratio in insurance? A. It measures the number of policies sold. B. It compares claims paid to premiums collected. C. It determines the maximum coverage limit. D. It sets a fixed rate for all insurance policies. Answer: B. It compares claims paid to premiums collected. Explanation. The loss ratio helps insurers evaluate profitability by measuring claims expenses against premium income. What is a binder in insurance? A. A temporary agreement providing immediate coverage until a formal policy is issued. B. A claim denial notice. C. A mandatory reinsurance contract. D. A policy exclusion. Answer: A. A temporary agreement providing immediate coverage until a formal policy is issued. Explanation. A binder ensures coverage is active while the final policy documents are processed. What does per occurrence limit mean in liability insurance? A. The total number of claims allowed per year. B. The maximum amount the insurer will pay for a single claim. C. The amount paid by the policyholder for each claim. D. The sum of all claims over the life of a policy. Answer: B. The maximum amount the insurer will pay for a single claim. Explanation. Per occurrence limit caps how much an insurer will pay for any single covered incident. What type of insurance provides coverage for legal expenses and settlements related to professional errors? A. Homeowners insurance. B. Professional liability insurance. C. Health insurance. D. Life insurance. Answer: B. Professional liability insurance. Explanation. This type of insurance protects professionals from claims of negligence or mistakes in their work. What is an umbrella insurance policy? A. A policy covering all types of risk. B. Additional liability coverage that extends beyond primary policy limits. C. A policy that combines life and health insurance. D. A mandatory policy for all businesses. Answer: B. Additional liability coverage that extends beyond primary policy limits. Explanation. Umbrella policies provide extra protection when standard liability limits are exceeded. What is the term for the amount an insured person must pay before insurance coverage applies? A. Premium. B. Deductible. C. Policy limit. D. Claim payout. Answer: B. Deductible. Explanation. The deductible is the amount a policyholder must pay out of pocket before the insurer covers the remaining cost. What does the term peril refer to in insurance? A. A hazard that increases risk. B. A specific cause of loss, such as fire or theft. C. The policyholder's total coverage amount. D. The annual premium for a policy. Answer: B. A specific cause of loss, such as fire or theft. Explanation. Perils are events that directly cause loss, such as floods, earthquakes, or fires. What is the main role of the insurance regulatory authority? A. To sell insurance policies. B. To regulate and oversee the insurance industry. C. To process insurance claims. D. To provide loans to insurers. Answer: B. To regulate and oversee the insurance industry. Explanation. Insurance regulators ensure that insurers operate fairly, follow laws, and remain financially stable. Which of the following best defines policy exclusions? A. A discount given on insurance premiums. B. The additional benefits included in a policy. C. Specific risks or circumstances not covered by an insurance policy. D. The maximum amount an insurer will pay for a claim. Answer: C. Specific risks or circumstances not covered by an insurance policy. Explanation: policy exclusions specify what is not covered by an insurance contract, such as intentional damages. What is an example of a physical hazard? A. A slippery sidewalk increasing the risk of falls. B. A person exaggerating an insurance claim. C. A policyholder committing fraud. D. A person driving recklessly. Answer: A. A slippery sidewalk increasing the risk of falls. Explanation: physical hazards are conditions that increase the likelihood of loss, but do not directly cause it. What type of policy covers financial loss due to a lawsuit filed against a business? A. Property insurance. B. Liability insurance. C. Auto insurance. D. Life insurance. Answer: B. Liability insurance. Explanation: liability insurance protects businesses from financial losses due to legal claims. What is a named peril policy? A. A policy that covers only specific risks listed in the contract. B. A policy that provides coverage for all possible risks. C. A policy that names the policyholder's beneficiaries. D. A policy that only applies to life insurance. Answer: A. A policy that covers only specific risks listed in the contract. Explanation: a named peril policy only covers risks that are explicitly listed in the policy terms. What is actual cash value, ACV, in insurance? A. The original purchase price of the insured item. B. The replacement cost of an item minus depreciation. C. The maximum payout for a claim. D. The amount of premiums paid over time. Answer: B. The replacement cost of an item minus depreciation. Explanation: ACV compensates policyholders for the depreciated value of a lost or damaged asset. What is a contingent beneficiary in a life insurance policy? A. The person who purchases the insurance policy. B. The person who receives benefits if the primary beneficiary cannot. C. The person responsible for paying the premiums. D. The insurance agent who sells the policy. Answer: B. The person who receives benefits if the primary beneficiary cannot. Explanation: a contingent beneficiary is the backup recipient of insurance benefits if the primary beneficiary is unavailable. What is the purpose of an insurance endorsement or rider? A. To reduce the overall premium cost. B. To add, modify, or exclude coverage in a policy. C. To cancel the policy immediately. D. To eliminate all deductibles. Answer: B. To add, modify, or exclude coverage in a policy. Explanation: endorsements, or riders, allow policyholders to customize their coverage. What is an open peril insurance policy? A. A policy that only covers one specific risk. B. A policy that covers all risks except those specifically excluded. C. A policy with no coverage limits. D. A temporary insurance policy. Answer: B. A policy that covers all risks except those specifically excluded. Explanation: open peril policies provide broad coverage, excluding only specifically mentioned risks. Which of the following is an example of a liability risk? A. A fire destroying a homeowner's property. B. A driver causing an accident and being sued. C. A factory losing inventory due to theft. D. A person losing their job. Answer: B. A driver causing an accident and being sued. Explanation: liability. Risks involve legal responsibility for harm or damages caused to others. What does primary insurance mean? A. The first insurance policy purchased by an individual. B. The insurance policy that pays first in the event of a loss. C. A temporary policy for a short-term need. D. The most expensive type of insurance coverage. Answer. B. The insurance policy that pays first in the event of a loss. Explanation. Primary insurance covers losses first before any secondary or excess insurance applies. What is the main function of insurance deductibles? A. To increase insurance claims. B. To lower insurance premiums by requiring policyholders to share some costs. C. To eliminate the need for insurance claims. D. To transfer all financial risk to the insurer. Answer. B. To lower insurance premiums by requiring policyholders to share some costs. Explanation. Higher deductibles typically result in lower premium costs because the policyholder assumes more financial responsibility for small claims. What is a retrocession in reinsurance? A. A reinsurer transferring part of its risk to another reinsurer. B. A policyholder switching insurers mid-term. C. An insurer rejecting a high-risk policy. D. The cancellation of a reinsurance contract. Answer. A. A reinsurer transferring part of its risk to another reinsurer. Explanation. Retrocession helps reinsurers manage large risks by further spreading them to other reinsurers. What type of insurance provides financial compensation when a business cannot operate due to covered losses? A. Business interruption insurance. B. Professional liability insurance. C. Life insurance. D. Workers' compensation insurance. Answer. A. Business interruption insurance. Explanation. Business interruption insurance helps cover lost income and expenses when a business is temporarily shut down due to insured events. What does aggregate limit mean in an insurance policy? A. The total amount an insurer will pay over the life of a policy. B. The highest deductible a policyholder must pay. C. The amount an insurer will pay per individual claim. D. The total number of claims allowed under a policy. Answer. A. The total amount an insurer will pay over the life of a policy. Explanation. The aggregate limit is the maximum payout an insurer will provide over the policy term, regardless of the number of claims. What is an example of a peril that is typically excluded from standard homeowners insurance policies? A. Fire. B. Theft. C. Flooding. D. Vandalism. Answer. C. Flooding. Explanation. Standard homeowners insurance often excludes flood damage, which requires a separate flood insurance policy. What is an adverse underwriting decision? A. When an insurer offers coverage at a reduced rate. B. When an insurer denies coverage or charges higher premiums due to risk factors. C. When an insurer automatically renews a policy. D. When a policyholder decides to cancel their policy early. Answer. B. When an insurer denies coverage or charges higher premiums due to risk factors. Explanation. Insurers make adverse underwriting decisions when a policyholder presents high risks, leading to higher premiums or denied coverage. What is an example of a contract of adhesion in insurance? A. The insured has little to no ability to negotiate policy terms. B. Both parties negotiate policy conditions equally. C. The policyholder drafts their own insurance contract. D. The insurer must pay claims without investigating. Answer. A. The insured has little to no ability to negotiate policy terms. Explanation. Insurance contracts are typically standardized and offered on a take-it-or-leave-it basis, meaning the policyholder cannot negotiate the terms. What is the function of a policy declaration page? A. It provides detailed information about policy coverage, limits, and premiums. B. It summarizes all insurance claims made by a policyholder. C. It lists all policy exclusions and denied claims. D. It acts as a legal contract between insurers and policyholders. Answer: A. It provides detailed information about policy coverage, limits, and premiums. Explanation: the declaration page is a summary of key policy details, including coverage amounts, deductibles, and insured parties. What is the main function of a surety bond? A. To act as life insurance for a policyholder. B. To ensure a party fulfills contractual obligations. Phi. To cover medical expenses after an accident. D. To replace standard property insurance. Answer: B. To ensure a party fulfills contractual obligations. Explanation: surety bonds guarantee that obligations, such as construction contracts, are completed as agreed. What does the term no-fault insurance mean? A. A policy that only covers damages if the policyholder is not at fault. B. An insurance system where each party's insurer pays for their own losses, regardless of fault. C. A policy that covers every type of damage. D. A policy that does not require premium payments. Answer: B. An insurance system where each party's insurer pays for their own losses, regardless of fault. Explanation: no-fault insurance helps speed up claims processing by allowing each party's insurer to pay for their damages. Which type of reinsurance provides coverage for an entire book of business rather than individual policies? A. Facultative reinsurance. B. Treaty reinsurance. C. Retrocession reinsurance. D. Excessive loss reinsurance. Answer: B. Treaty reinsurance. Explanation: treaty reinsurance covers a group of policies rather than individual risks, providing broad risk sharing. What does coinsurance penalty mean in property insurance? A. A reduction in claim payout if the insured amount is lower than required. B. A bonus for policyholders with no claims. C. A fee for filing multiple claims in a year. D. A discount for maintaining a policy for many years. Answer: A. A reduction in claim payout if the insured amount is lower than required. Explanation: if a policyholder underinsures property, they may face a coinsurance penalty, reducing their claim payout. What is self-insurance? A. A policy purchased from a private insurer. B. A company setting aside funds to cover potential losses instead of purchasing insurance. C. An individual buying multiple insurance policies. D. A government-run insurance program. Answer: B. A company setting aside funds to cover potential losses instead of purchasing insurance. Explanation: self-insurance involves an entity assuming its own risks rather than transferring them to an